All right, everyone. So thank you again for joining. This is My Finance Foundation's My Finance Foundation's Financial Literacy series uh, presented by myself, David Council, and in association with Council Enterprises. So today our topic is insurance. And what is that? So today our topic is insurance. We've had a series of different topics over the course of our time, but this one rounds it out. And you might ask, well, what is insurance? What is life insurance? And so a life insurance policy is an arrangement between an insurance company and a person or a legal entity. And so that's what most people, kind of think about, but not necessarily understanding that it is a contract. And so essentially, in exchange for your premium payments, the insurance company will pay you a lump sum known as the death benefit to your beneficiaries after your death. The beneficiaries can use the money for whatever purpose they like. So that's what life insurance is. What is the purpose of life insurance? So while many people use life insurance for different reasons, the purpose of life insurance is to provide a financial benefit to dependents upon premature death of an insured person. People also purchase life insurance for other reasons, including the following: to provide income to replace lost earning potential, to pay for college education, to fund retirement plans, to fund business or partnership buyouts in the event of the death of one of the business owners, to indemnify a loan in the event of premature death, and we'll discuss that later, and to fund dependent or family legacy wealth building plans. So, what are the primary types of life insurance? The primary types, or most common types, are term life, universal life, variable life, and whole life. And while there are several different other types of insurance, life insurance, these are the most common, and those will be the focus of our presentation today. And so that includes the overview, and then now I'm going to jump into some of the details of different types of life insurance. And so you can find these sites. So this is Progressive. They sell insurance, and they kind of go through the different types of life insurance and what they are. And so term life is temporary. Life insurance is generally not permanent. The reason why it's called term is because it has a term limit. And for that reason, it's generally more affordable than permanent life insurance. At the end of the period, some options, depending on the type of policy you purchase, you can renew your policy at adjusted rate, but you can, if it's a renewal type of deal, you can only renew for a year-on-year basis after that, not for another term period. And each different renewal will be based on your age and health at the time of renewal. Permanent life, so when we look at those, the permanent life includes universal life and whole life. And the whole life insurance is exactly what it sounds like. It insures you for your whole life. It's a type of permanent insurance. It builds cash value, has a death benefit, and if you want to get the cash value prior to your death, obviously if you die, you won't be able to use it, but prior to your death, you can withdraw a portion of that to use for whatever you want. Universal life is similar. It's permanent. The difference is you get interest or participation in what is called either a index or a fixed rate, as opposed to with whole life, usually you get paid dividends. So those are the primary differences. And then the other differences come within how the premiums are structured month to month. So as this talks about and shows here with universal life, interest rate for universal life policy, cash value is not fixed. You have a guaranteed premium interest rate in general, but the rate at which your cash value bills can change over time. And then there's other types of universal life where which we'll go over, such as index universal life, and that's tied to an index, and I'll go into detail on that in a moment here. The next kind is variable life. All that means is it's a combination or a hybrid of universal life and whole life. The difference being it's riskier, and the risk comes into place with the cash value. So instead of getting a guaranteed or a floating rate like you would have with a universal or a participation in an index with index universal, or with whole life where you get dividends, in this case, you get none of that. What you get is participation in a free market type of portfolio. It's almost exactly like investing in the stock market directly. It's just this is wrapped into an insurance vehicle. So when you invest in an IRA, or when you have an individual retirement account, a 401k account, or any different type of brokerage account, you are participating in the stock market. A 401k and an individual retirement account, the difference is you get tax deferred benefits. That is the same with variable life insurance. The difference between a 401k, an IRA, and a variable life insurance contract is that the cash value grows. It has a cash value component, but it also has an insurance component. So think of variable life insurance as IRA or 401k with a life insurance policy attached to it. Final expense, that's not on our list of most common, but people do get insurance for final expenses. That's usually when you're older and you don't already have an insurance policy in place, and so you get something that would potentially give you some coverage for your final expenses. So I'm going to show you several different charts from several different sources, websites, to kind of give you an idea of the difference between each of the insurance types. And we can talk about which one is the most favorable or not, depending on the situation. But this is intended to be a high-level overview rather than a detailed overview. And again, all this information is on the Progressive website. It is on the NerdWallet website once we get to that, and then Prudential websites as well. So what we're looking at here is the comparison of term, whole life, universal, variable life, and final expense. If you notice here, the coverage length is permanent or throughout your lifetime. What this means here is the best ages, or the time when you would want to be insured, is 18 to 65 for these different types here. Final expenses, obviously, as I mentioned earlier, a lot of the time people in this market get final insurance if they don't already have whole, universal, variable, and their term has expired. And so it's a somewhat cheaper version to get some coverage so that you can have some type of burial or final expense insurance. As I mentioned, term is not permanent. It is impermanent insurance. It is temporary within these coverage periods or length. So 10, 15, 20, 30. Does it build cash value? No. Is a medical exam required? Sometimes. This is starred as yes. Most of the time with whole life, it's yes. These, although they say yes, they don't always require an exam, and we'll kind of get into some simplified underwriting versus full underwriting, but that's not the primary purpose of this presentation, but just wanted to give you guys a little bit of insight into the types of underwriting. But when you see this, all that means is you could or could not have a medical exam requirement. I purchased insurance, life insurance, without a medical exam in some cases. If you don't have a medical exam and you're healthy, then your premium could be higher. So those would be the differences. So if you have a medical exam, it gives the insurance company more information. And so when they do full underwriting and you get a medical exam, it could bring down the amount that you pay for premium if you are healthy. If you opt to do a simplified underwriting process, that means no medical exam, and the premium is generally going to be higher because the insurance company doesn't have as much information, so they can't assess the probability of having a payout. So it's going to be more expensive. The death benefit amounts, these vary, but as you can see, the further down the scale you get, it gets lower. You can get a lot of insurance for very cheap on a term basis because it is temporary. So we'll just kind of go through this really quick. Other types of non-traditional are guaranteed and simplified. Simplified is kind of what I just mentioned, where you get insurance without a medical exam. Guaranteed issued is similar to final expense, where you don't have a medical exam, and it is later in age types of insurance. It's less proactive insurance. So we'll go to a more detailed version. And so now that we have this, I'll save this and have it as a resource for later. And I'll drop it in the follow-up email. So this here for NerdWallet goes into a little bit more detail. And so remember I talked about Universal. Index Universal is a version of Universal. And most of these are permanent. Obviously, term is the only one that is not simplified. You can get both term and permanent. Guaranteed, as we talked about, that's similar to the final expense insurance. You can get that on a term and permanent basis. Group life, hadn't talked about that yet, but most companies that you work for will have group life. That's what's called group life. And so the focus of this presentation is not on group life. The focus of this presentation is insurance that you would purchase on your own outside of your job. The reason why I want to focus on that in terms of financial literacy is because if you ever leave your job or you are displaced from your job, then so will your insurance be, your life insurance. And so you will cease to have life insurance coverage if you leave that job. So the point of the financial literacy is to make sure that you are covered and that you have insurance regardless of whether you are at a certain job or not. So let's go through some pros and cons. We already know what term life insurance is, so let's look at the NerdWallet site to get some pros and cons. So a pro of life, as I mentioned, term life, is that it's often the cheapest and it's sufficient for most people. The con is, let's say you get a 10-year policy, 20-year policy, and you live longer than 20 years. Well, you don't get a payout because you wouldn't get a payout because you're dead, but your beneficiaries won't get a payout, and you would have paid because you're still living. You would have paid for a policy and you get no benefit. The next one is whole life. Again, it's permanent. Let's go over some pros and cons. It covers your whole life and it builds cash value. Cons is typically the most expensive one, and I'll get into why a little bit later, but it's generally the most expensive one. And so for that reason, generally speaking, it's not worth it unless you're doing it for a specific strategic reason. Variable life, similar to, like I said, the IRA and 401k, with a retirement structure with insurance wrapped around it. It is, as just mentioned, tied to investment accounts. And so if you were going to use this as a vehicle to build cash value, the cash value could potentially grow way beyond what you would experience with a whole life policy or universal life policy. But the downside is you would experience downside risk to your cash value if the market does not perform well. So this explicitly says that, but in a different way. It requires you to be hands-on in managing your policy, as the cash value can change daily based on the market. Universal life, similar. Like I said, there's guaranteed universal and there's index universal. Guaranteed universal is basically like whole life, but the difference is, as you can see, because of its minimal cash value, it's cheaper than whole life and other forms of universal life when it guarantees. Like, it's a guarantee you a small amount of interest. So like right now, interest rates are, let's say, 3.5 on a 10-year, something like that, or out to the 30-year. They'll guarantee you 4.5% forever, as long as you live. But that's not as favorable as it would be for a whole life insurance policy, where you get to participate in dividends and your cash value builds a lot faster. So it's cheaper, but the cash value doesn't build as fast. But again, if you're risk averse, this is good for you because, hey, you don't have to worry about any market risk or being as actively involved in your policy. Here, additionally, there's risk with payments. So you could get an additional rider to help cover the premiums if you don't have the money to pay for the policy for a month or a year or however many times you don't have the money to pay for it. But with these, if you miss a payment, then there's a window, a short window where you could catch up. Otherwise, you forfeit the cash value, and then you won't have any policy at all. Index universal, again, similar to whole life, is permanent. It's similar to guaranteed universal, but with this one, you can access the value anytime you want as well. But the key difference here is that the cash value is you get a participation interest credit, and all that means is, let's say you have $10,000 in cash value in this policy. Well, the insurance company treats that $10,000 as if you were invested in the S&P stock market index. And if the stock market goes up 20% and you have a participation rate of 100%, that's what this is down here, then you get to participate in 100% of that 20% up to 10%. So there's caps usually. So that's all that means. So the benefit there is you get 10% on your cash if the market goes up. If the market goes down, you don't make any money, you don't get anything, but you also don't lose money. So it all depends on how risk averse or not you are. And so, as we talked about in the guaranteed universal life, in this case, you're guaranteed 4.5%. In this case, if the market goes down and it's negative like it is this year, you probably won't get anything, but you won't lose money. So you're not going to get your guaranteed 4.5%, but you're not going to get negative returns. And that is the key difference with like a variable life. Like if the market goes down, in this case this year, like it's down like 15%, then your cash value is also down like 15%. So those are the ins and outs of the different types of insurance. And this is kind of a review of what we talked about earlier. Fully underwritten means that you get a medical exam. The insurance company has more information to use for underwriting a policy or taking on that risk of insuring you, as opposed to a simple issuance policy in which there's no exam and the premiums are usually higher. So any questions before I move on? All right. No questions.
David, one question.
Yeah.
The variable insurance, give me a little recap on that.
Okay, so the variable life insurance here is just your regular insurance policy. So each one of these has, so when you start with term and work your way down, every additional type is a term insurance policy with a permanent component. So that's how you should look at it. You start with term, and every other type is just a policy, a term policy that can be, the cost of the insurance continues for your whole life, right? So it extends that term, but it has a cash value component. And so with variable life, it has that whole life insurance piece. So it covers you for the whole part of your life, but it has a cash value component. The cash value component has your funds invested in the market. And so the difference is your funds are at risk. With the other types, your funds are not invested in the market. With the whole life policy, your funds are with the insurance company, and they give you a dividend based on the return on investment that the insurance company has year after year. So if you have a whole life insurance policy with New York Life, for example, and New York Life did really well that year, then you get a dividend for having a policy with them and having your cash value with them. Universal Life, the difference there is instead of having your money in the market, you have your money with, say, New York Life. Let's stick with New York Life. So instead of them giving you a dividend with Guarantee Universal, they just pay you interest every year. That's it. With Index Universal, they give you what's called an interest credit. So your money is not invested in the market. It's just sitting in an account. And at the end of every month, the company either gives you an interest credit or they don't give you anything. The interest amount that you get is based on the performance of an index. And so if the index goes up, then you get paid. If it doesn't, then you don't get anything. And so that's the difference.
But you don't lose anything, right?
Correct. Exactly. So that's why a lot of people, so in terms of risk profile, the least risky and most expensive is whole life.
Yeah.
The second most expensive, well, I would say it's less expensive, but less risky, is Guarantee Universal Life. So it's cheaper and it's less risky, but you get less money. Index Universal is kind of like a mix of both.
So what is the recommendation of which insurance that you get? Get your preference.
Well, it really depends on your risk tolerance. And so I'll get into that in a second. So let me
Okay.
but yeah, I will definitely get into that in a second. So let's see. So when we look at this and we look at the how much you should get and for what you should get insurance for, we talked about covering loss of income. We talked about indemnifying things. Me and Matt talked about that with some of the things that he was working on or working with. But it's several different reasons. So before you buy insurance, you have to understand what you're buying it for. On a very basic level, you want to make sure that you are covering income for whoever your beneficiaries are. So if you're single and you have no beneficiaries, no home, no anything like that, no mortgage, then you don't necessarily need insurance unless you're trying to use it for a retirement supplement, because no one is dependent on your income and you don't have any debt. So before you buy insurance, it's important to think about what you're buying it for and why. And so you buy insurance when these life changes happen. And so you shouldn't buy more insurance than you need, but you shouldn't like not buy enough, because some people don't buy enough. And so it's different strategies that you can implement to address whatever your personal situation is. So you can use term and permanent to get the benefits of the features that they offer. You can also use different riders. Those are additions or adjustments to your policies to help with whatever objective you're trying to achieve. So let's look at this a little bit more and look at a little bit of the life cycle of insurance and what you would need it for. So as I mentioned, if you're single and you don't have any responsibilities, then you don't really need a lot of insurance. Nobody's dependent on your income. You don't have any debt. You don't really need to buy a lot of insurance at all. You could still, again, like I said, you could use insurance as a vehicle for supplementing your retirement. And if you're a high income earner, then you can use variable universal or index universal to supplement your income and build up a retirement fund. However, if you have a house or if you have children, then you're going to need more insurance. If you have a spouse and you're a high income earner, then you're going to need even more. And then let's say college ends, your kids are out, and your mortgage is paid, and your children are independent, you don't need as much. And so then your insurance needs go down. And so then now let's say you're completely retired, your kids are out of the house, you've been saving your money this whole time anyway, so your insurance needs are just less. And if anything were to happen to you, you started saving and earning this whole time, so you have money in the bank and investments in the bank. So now you're basically self-insured, so you don't need to pay anyone to insure your income. So those are some things to consider in terms of what insurance, life insurance is, why you need to get life insurance, and what amount you need to get it for. So, which brings me to this. How much life insurance do I need, right? So let's go down here. This is a nice little calculator. I like this. I have my own, which I'll show you guys in a second. But what type of insurance is best? Okay, do I want to pay off all my debts? Yes. Do I want to provide for my children? Yes. Select yes. Leave an inheritance. Remember, these are all different things that we were talking about. If you don't have any children, that doesn't apply to you. If you have no debt, that doesn't apply to you. You definitely want something for a funeral, obviously. Do you want to leave an inheritance? Each one of these is different decisions. An inheritance for your kids if you have kids, or extra money in retirement. So these are the key decisions that you want to think about and evaluate when you're looking at the type and mix of insurance that you're going to purchase or that you would want to purchase. So let's look at this. If you make, let's say, the example I use, and I'll show you guys in a second, is 65. That's the amount that I've been using for all of our tools. So if you make $65,000 a year and you want to, let's say you have a kid, you just had a kid, let's say in Sydney's case, 30 years old. Well, she's not 30 yet, but let's just jump ahead to make the number even. So she's 30, $65,000 a year, and she wants to make sure that she has 10 years worth of income to cover her in case anything happens. You also then want to consider, if she continues to live for additional 10 years or however many years, what her anticipated pay raises would be per year. And so that takes you up to 681. Now, if she has a mortgage, let's say she has a mortgage of 275 and a car loan of 20,000. Doesn't have any home equity lines out, because we talked about that. You don't want to overextend yourself. But let's just say she did. Let's say she had a home equity line of credit for $25,000. And she also had a personal loan of $5,000. And she also had student loans of $20,000. You see how this is all adding up? And then, oh, by the way, she has $5,000 in credit card debt. So her total debt, if she were to pass away right now, is $350,000. And obviously, I'm not going to go, to get a quote here, but that's what you would do. And so, what does that mean? When you look at that and you add these two up, income replacement and debt coverage, that's about $1,030,000 that she would need to purchase to cover her income replacement for 10 years and her outstanding debts. Now, I like to do my stuff manually. That's just me. Everybody's different. And so these are some methods that you can do to calculate it manually. How do you do that? So we can look at it from this methodology that we just looked at. So your financial obligations minus your liquid assets. So we just took Sydney's income over 10 years with raises of $681,000 plus her outstanding debt of $350,000. So that's $1,030,000. And then you can subtract how much liquid assets you have. And so say let's just say let's keep it even, $1 million, right? And then let's say she has $100,000 in the bank. So you want to take 900 as the amount that she needs to use for insurance, because whoever gets her insurance after she dies is also going to get her cash. And you add the insurance of 900,000 plus her cash, then you get to 1 million. Remember what I was saying, as you go throughout your life cycle, assuming that you are saving and investing, then by the time you get toward the late stages of your life cycle, your insurance needs are much less and your cash has caught up. And so now you are self-insured. So that's the goal there. So anyway, so take your annual salary, multiply it by the years that you want to replace income, your mortgage balance, other debts, any future needs such as college, funeral costs, cost to replace services, that kind of thing. That's one way. And so how do we do that quick and dirty? You can multiply your income by 10. That's one of the things that I use, and I'll show you guys that in the model later. Plus another 100,000 for each child that you have for college. Then you can use the DIME formula, which is debt, final expenses, then income, mortgage, education, right? So these are just kind of the stages, the 3 ways and stages of coming up with what your insurance needs are. This one is easy for illustrative purposes, so that's kind of what I used. And so now we can jump in, and then I'll sort of address that question that you had about what is the mix. And so tips for calculating how much you need. Think of life insurance as part of your overall financial plan. That's why we're covering it in this financial literacy piece. Don't skimp. So more than likely your income will rise over the years. And again, what stage you're in life depends on your insurance needs as well. And so talk the numbers through with your family. So with you, Mr. J, I mean, it really depends on what your objective is. And so, your objective is going to be different than Sydney's with Kai. And her objective is going to be different than Matt's, who is a homeowner but doesn't have kids. And also is going to be different than Trina, who is retired with no kids. So, and which is also different than me and Tisha, was married with the expectation that we will have a kid. So each one of those is different and requires different planning for different reasons. And so you could buy multiple smaller life policies, or you could buy more than one insurance policy to cover your coverage as your needs ebb and flow. So you can buy a 30-year term to cover your spouse until your retirement, 20 to cover your children until they graduate, and then compare it all together. So
now, as a new grandparent and you want to cover your grandchild. So how do that work? What's the best insurance to get for that? You know, to help her like uh for college or life, you know, something like that.
So again, it depends on how risk averse you are. Um, and if it's just for that, I mean, a variable universal life will have the highest upside potential. It's the riskiest because the money is invested in the market, but it has the highest upside potential.
So
That
let me ask you this there, but excuse me for interrupting.
oh no no
So
no.
on what the life insurance you just said, is that possible that you go down to zero and lose all your money?
Yes.
Oh shit.
Just like you know, if you have a regular IRA or a 401k, the funds can go to zero. It's unlikely, but if there's a losing year like this year where the S&P is down 15 almost 20%, then your portfolio within that insurance policy is going to be down. But when the market turns around, and let's say next year the market goes up by 40%, then your cash value will also go up by 40% with the market. So you get 100 participation with the highs and the lows of the market. If you have an index universal life, then you get capped out at, say, you know, if the market goes up next year at 40% and you have 100% participation, then you're only going to get 10%. But in a year like this year, when the market is down, then your cash value doesn't go down. So it just really depends on how risk averse you are now. So for me, and I put this together as an example of what it might look like for Sydney or Matt or myself. This wouldn't necessarily apply to you or my Aunt Trina, just because of the cycle. So it's different cycles. Now for Kai though, you know, an index universal or a uh, variable universal would work because she's a baby, and 18 to 20 years is a long time. And so even if the market went down this year to 30-40%, and then next year went down again to 30-40%, it really doesn't matter because with the index universal, I mean, the variable universal life, it's like, again, having an IRA or a 401k and your dollar cost averaging. So she's going to be buying stocks when they're super low. And then when the market goes up, obviously she's going to be buying highs, but she's going to be buying less at those higher highs. And so her cash value will be way greater than it would be here. But again, it depends on how severe the losses are. So, you know, that's why I like mixing it up. Here, if you have, let's say, 40%, if you're risk averse and you don't want to have too much exposure to risk, you say, well, I'll do 40% in the index universal, and then I'll do 60% in the variable universal. And that way, for her, I would lean more. I would do this. It was me. We have two policies, one with index universal and one with variable universal. But you can always change the mix. You can increase, decrease. These policies are pretty flexible. And so because she's a baby, because she has a lot of time ahead of her, index universal, a variable universal would be perfect. So this kind of illustrates what I was talking about with like the insurance mix and why. And so this is set up for, say, Sydney, who has a mortgage. Now, I don't know what her income is, but this assessment here is just based broadly on her income. And what it does is it gives her that income that we were just looking at from NerdWallet. It was like, multiplying your income by 10. And so the insurance coverage at 750 is 10 times her current income. Now, what we looked at is, student loan debt, homeowner debt, and all these different things. So that drives how much insurance she's going to need. So in this case, I used the mortgage that I used from our debt planning session. And so I just put that in here as an example. So obviously, if your mortgage is higher, then you're going to need more coverage. And so in that case, depending on the methodology you're using, you would need to include higher amount of insurance. But what this does is it rolls off. So you have a 10-year, $100,000 policy, 30-year, 20-year, $300,000 policy, and a 30-year, $100,000 policy. What that does is that allows you to purchase a $500,000 policy that will cover you for 30 years for $72 a month. Generally speaking, that would be cheaper than purchasing a 30-year, $500,000 policy, because you don't need the whole $500,000 for 30 years because your needs are going to change. So if you lock yourself into a 30-year term, yeah, you have $500,000 for 30 years, but you're paying more than you need to for coverage that you won't need for the full amount of time. Because here, and that's what we'll look at here, your mortgage, after the first 20 years, your mortgage is going to go down, right? So then now you just don't need as much insurance in year 21 to year 30 because your mortgage only has 100 left. And then this is if you die here between year 21 and 30, you still have 242,000 that you have available to your beneficiaries after they pay off the outstanding loan. Here, the thing that's left is your permanent policies, which is this 250 here. Because now it's no more mortgage, so you have 100% of your insurance going toward your beneficiaries. And so what happens is, as the years goes along, you have less coverage because you don't need it, and you're paying less money. So it's front loaded. You have the most insurance during the years where you would need it the most in case something were to happen to you. And so going back to Sydney's case, in this case, she has a mortgage and she has a kid. And so when I was talking about indemnifying or paying off a loan or a mortgage, you can do what's called assignment, or she could do assignment, and she could assign this $100,000 and this $300,000 to the mortgage company. So if something happened to her, the mortgage would be paid first, and then the remainder would go to the beneficiaries. And then the rest could be used for income, covering lost income, and anything else. And so these are the ages at which those expire. So after 40, she would have knocked down, in 10 years, $50,000 to $100,000 on a mortgage. So this is no longer needed, so it goes away. Here, another 100,000 or so, or 50 or so on the mortgage over 10 years. And so this is less needed, but Kai is older and going toward college age, so she still needs a little bit more insurance here, which is why this 20-year is the biggest. Once Kai's out of school, of course, Sydney's continuing to save and invest, and so she won't need as much here, and she'll have more cash later on. By this time, she'll be 60, and she'll still have these in force as well. And so the idea here with these terms, you could just go ahead and get 750 in whole life, variable, or universal life, but that would be very expensive. The reason why we're doing this with the terms is because you can take that and you can invest the difference. And so I'll show you that in the next piece over here when I get to it, so you can see what I mean. You don't want to get a whole bunch of insurance that's permanent because it's super expensive. You can invest the difference. This is a coverage, super small, but this is what a coverage waterfall looks like. And so over the years, what will happen is she'll have 750. After the first 10 years, it'll be 750. The 10-year policy goes away after the first 10 years. After 30 years, then she's just left with the last 30. And then after 40, when she's 70, she just has these. And that makes sense. The older you get, the less dependence you have, the more they're financially independent and all that. You just don't have as big of a need for insurance. But you also want to use the ladder tool to help cover those premiums as you go along as well, because it can be expensive. And like I said, that's $400 a month, $462 a month structured that way. If you did all whole life, it would be way more expensive. You don't get that big of a drop off as the years go by, but it's still less money per month that you're paying after that first 10-year policy expires. Then after the 20-year goes away, that's $47 a month that you're saving. And then here, finally, after 30-year expires, you're only paying $390 per month. Now, you can see how that stacks up on a cumulative basis with the premiums. Now, the difference is, one of the things that I like to do is I like my premiums to stop. So these are in line. So you can make them stop at whatever point in time you want them to with the whole life policy. So for me, I do mine on 15. So all the premiums stop at 15. And what that means is I pay up front earlier in the cycle so that I don't have premiums later on. And so you could do, what I just did was I changed the premium stop period from 40 to
Say that
50.
again, Dave. What you mean you paid in advance?
So you can front load your premium. So for example, with, good question. So with this one, this variable universal life, you could do what's called a 20 pay or 15 pay. So any of them are like that. So index universal, variable universal, and whole life, you can do 15, 20 pay or 30 pay, however quick you want to pay it. What that means is you only pay premium for a certain number of years, and then you don't pay premium after that. And so you pay, let's say if you know, it's a permanent policy, but you stop paying premium after 15 years or 20 years. You pay more up front, but after 15 years, you're not paying anymore. And so this is one of my tools that I like to use, or I did use, to evaluate the cash value and the pay amount, like how often you pay. And so I got a bunch of quotes from different insurance providers for permanent life insurance. So the 30 pay version, 20 pay, 7 pay, 20 pay, 30 pay, whatever, 15 pay. And so I looked at those and I said, okay, well, which one of these do I want to evaluate the most? And how much money can I afford? So you got to ask yourself, what am I doing? Why am I doing it? But then finally, after you figure out what you want to do and why, then you got to figure out how much money do you have in your monthly budget to implement your strategy. If you don't have a lot of money, then you have to evaluate or assess what you can afford. You might want to do something, but you might not be able to afford whatever it is you're trying to do. And so that's one thing to consider when you're looking at each one of these. The next thing is, you asked me about the variable life, and I like variable life, if you notice, for Kai or somebody young, or index universal life. Those work because they build cash value a lot faster, and they give you, participation. They're less expensive than whole life. Whole life has a place, but when you mix it appropriately. all this is a fancy way of saying, okay, well, if I'm looking at when I like to look at these, and I talked about term versus whole life. When you're looking at one versus the other, you want to make sure that you're looking at what's called the IRR. And all that is a numerical expression of buy term and invest the difference. Dave Ramsey talks about it all the time. Insurance people will try to sell you whole life, index universal, and variable universal because they get paid more. It's a very useful product, but the person selling it to you gets paid more. With term life, they don't get paid as much. And term life, again, like I mentioned, is way cheaper because it's not permanent. And what you can do is, let's say if your term policy is $50 a month, and your whole life policy, let's take a look. The whole life policy is $247 a month, right? So let's look at that. $247 a month versus a term life for $500,000 for 20 year, 500,000 policy term, $32 a month. Well, wow, that's a big difference, right? Why would you pay $247 for $100,000 when you can buy this and invest the difference, right? So that's what Dave Ramsey always talks about. Now, does it make sense to buy term and invest the difference? Well, it depends. It depends. Let's take a look. So for me, the mix, and this is what I was looking at the mix of term and whole life. Now, if you know that you do not know how to invest properly, and you do not have the time, and you don't have the discipline to take that difference between what I just showed you of 247 and 32, which is about $200 a month, $210 a month. If you are not going to invest that $210 a month, then go ahead and get you a whole life policy. Go ahead and get you an index universal life policy. But if you know that you are going to take that $210 and then invest it in a tax efficient way, then it makes sense to not get the policy. Now this shows you where all of that kind of meets in the middle. If this number is negative, what that means is I would be better off investing the difference. So my internal rate of return of investing the difference is 120% versus 98%. Now, am I guaranteed to make that 120? It depends on how good I am with investing my money. I may or may not do that. And if you, like I said, don't really know what you're doing or how to do it, then it might make sense to put your money in a whole life policy. But if you know what you're doing, then you basically are you're leaving $23,000 on the table. That's your opportunity cost in this scenario, and in this scenario, and it's 34. So that's just comparing whole life. And as you look, this is the premiums that you paid, total premiums paid, and this is the cash value. This is the difference here between the cash value and the premiums that you put in. However, if you invested that minus the taxes, you would have had $192,000 instead of $161,000. And so the opportunity cost in that case is $31,000. Well, for me, I'm like, well, that's a decent sized amount of money. So does it make sense for me to put it in a whole life policy and have to go through the frictions of getting the money? Probably not, but somebody else might make sense. So it just really all depends on your level of discipline and how willing you are to invest the difference. There's also other issues that you would have to consider when you use a whole life policy or index universal policy to access cash. So you can withdraw the cash, but it's not like a bank account. So if we go back and let's say we're looking at let's see, let's go here. So let's say for Kai, right? So she would have access to, if we did a $100,000 whole life policy, she would have access to, if we did this combination or this scenario, she would have $120,000 in cash value at the end of 20 years. However, in order to access that, she would have to borrow against the policy to get the money out. Or she could literally take the money out tax-free if it's less than the amount of premium she paid, which in obviously in this case, you know, the total amount, depending on the policy, could be less. But you know, the whole point of this exercise is that you would get more growth doing it this way. But if she wanted to take money out that is less than the amount that she put in premium, she could do that, but she can't put the money back in. It's not like a retirement account in that regard. It's not like an IRA or anything like that. Once the money comes out, you can't put it back in. And you know, it's similar to like a 401k at your job, right? Like once you take the money out, you can't put it back in. You can reinvest in 401ks and all that. So like you can, if you take that, if you like literally take a loan, you could still have the money there, and you could have the cash available to you, but you have to pay it back, and there's interest charges and all that. But with a 401k, once the money comes out, that's it. Similar with an insurance policy. Once the money comes out, that's it. If you have an IRA and you take money out, you can put the money back in, but whatever you invested in, you can't go back and get the 20-year price. You have to pay today's price. So you know, it's always a trade-off. So those are some things to consider as well. But I hope that was helpful. I know it was a mouthful,